Hi guys, I'm back with a very interesting discussion on a concept called revaluation. Now, the whole idea of revaluation stemmed from the fact that businesses started feeling the need to incorporate fair value in their financial accounting, reporting, and presentation. Now, what is fair value is a separate discussion that we will be doing when we touch upon IND AS 113, that is on fair value measurement. At this point, let us keep a very simple understanding of fair value. Fair value is the price at which an entity would sell an asset or exchange or transfer a liability between two unrelated parties at the measurement date under normal market conditions. Basically, fair value is your arm's length price. Of course, there are more contours to this, but right now I'm just keeping it very, very simple. When I was studying to be a chartered accountant, and that is more than a decade ago, the use of fair value in accounting was not so prevalent. But right now, the way most of our IFRS or IND AS, the way these have been shaped, fair value accounting happens to be a very major part of all the financial reporting. So in IND AS 16, after we have done the initial recognition and at cost, the subsequent measurement is something that we have to discuss right now. And there are two ways in which the entity could present this information in the financial statements. Now, if you observe, after the asset is acquired and the initial recognition is done at fair value. After the asset is acquired and the initial recognition is done, subsequent measurement basically discusses how exactly is the asset going to be shown in the balance sheet. When I purchase the asset, I record the asset at cost. And what is cost? We understood what all items are included in cost. The cost of purchase, any amount incurred which is directly, any amount incurred which is necessary to bring the asset to its current location and working condition has to be capitalized. And there was an entire list of items that we looked at this way. Now, in subsequent measurement means after initial recognition, how exactly are you going to present this information in the balance sheet? This is what subsequent measurement talks about. Now we have our original method, which is the cost model or the historical cost model. The asset continues to be shown at the value at which it was originally purchased, and depreciation is calculated on original cost. So if I purchase, say, this gold ring that I have, say I purchased it on 11th of November 2014. At that point time, it weighed 10 grams. Even today, it weighs 10 grams only. At that date, this gold ring was purchased for 25,000 in 2014. So when I purchased the gold ring, I recorded that at cost and I recorded an entry by gold ring account debit to bank account. By gold ring account debit to bank account. 25,000 was the amount that I paid, and I got this gold ring for 25. This 25,000 is my original cost or my historical cost, and I will continue to show it in my financial statements at cost minus accumulated depreciation. So, this model wherein we show the item at the historical cost minus the accumulated depreciation till date is the first model of presenting information in the financial statements. The second model is known as the revaluation model. The asset is revalued to its fair value on the balance sheet date, and fair value is fair value as per IFRS 13 or IND AS 113, depending on how you want to look at it. It's basically one and the same. Now, I purchased this ring for 25,000. Okay, I'll show this ring to you. I purchased this ring for 25,000. It has some stone in it. My mother asked me to, wear it for some reasons, and I didn't want to argue. So, like, okay, fine, I'll wear it. Anyway, that's not the point. So I purchased this gold ring for 25,000 on 11th of November 2014, which happens to be my birthday. And I recorded that at 25,000 historical cost. Initial recognition happens at cost. Now, on 31st of March 2025, this gold ring is for 78,000. On 31st of March 2025, this gold ring was for 78,000. Now, my because I have used the historical cost basis of accounting so far, right now this ring appears in my financial statements at 25,000. But when I ask someone what is the price of 10 grams of gold and this precious stone, the person tells me that the value of this is 78,000. Now think about it, that the users of financial statements, the ones who are, looking at my financial statements, they look at the financials and they see one asset at 25,000. They think that the value of the item that I own is 25. What is misleading in this situation is that you have an item worth 25,000 which you had purchased, but today its value is 78,000. So don't you think the users of financial statements expect that they should get to know that the value of this item, which was originally purchased for 25,000, the value of this item today is 78,000? Don't you think they have the right to know that? And don't you think you are misleading them if an asset which is worth 78,000 today, you are continuing to show that at 25,000? So, because fair value has become such an important part of our discussions, what we are going to do is we are going to now we want to show the ring that was originally purchased for 25. I want to show it at 78. So I will increase the ring account by 53,000. 78 minus 25, 53,000. I will debit my gold ring account from 25, debit by 53, it will come to 78. The question is, the increase in value here that has happened from 25, it has gone to 78. This increase in value is my gain, right? Increase in value of an asset is my gain. But the thing is, I have not yet sold the asset. The asset has not been sold. The fair value has gone up. And because the asset has not been sold, I cannot say that this gain is my realized gain. I have not yet realized this gain. I have not yet sold the asset to call this gain as mine and consider the transaction complete. So at this point, while there is an increase in the fair value, the gain is still an unrealized gain. And because the gain is an unrealized gain, it would be incorrect to transfer this gain to your profit and loss account. It is not your regular income, it is your unrealized gain. And because it is your unrealized gain, the smarter approach would be to route it through other comprehensive income. It is my income, it is my gain, but it is not yet realized. So the accounting entry for an upward revaluation in a non-current asset is non-current asset account debit to revaluation surplus. So revaluation surplus OCI is credited and the non-current asset account is debited. So we are talking about a situation where there is a first time upward revaluation, as you can see here from the data appearing on your screen. Now, think about it, that initially we purchased the asset for a particular value and now we revalued this particular item. This process of increasing or changing its value and bringing it up to its fair value right now is known as revaluation, valuing that particular item again. Now, under the revaluation model, for property, plant, and equipment, assets are carried at their fair value in the balance sheet. After the revaluation is done, depreciation per annum is calculated on the revalued amount. Depreciation continues to get calculated and recorded in the financial statements. So depreciation, be it your cost model or be it your revaluation model, the accounting entry for depreciation is a must. No option there. And the thing about revaluation is that revaluations must be made sufficiently regularly to ensure that there is no material difference between the carrying amount and fair value at the reporting date. Now, our international financial reporting standards and consequently our IND AS also are they are a principles based approach. They are not a rules based approach like US GAAP. So they do not tell you the number of times you have to revalue. What they say is a very logical statement. What they are saying is, instead of having a frequency set this way by defining a number, you should do your revaluations with that level of regularity so that there is hardly any difference. There is hardly any material difference between the carrying amount of the asset and the fair value at the reporting date. So this frequency, it will depend upon the movement in values. Not all items fair value will move that frequently. So utna you have to keep in mind that it has to be done with sufficient regularity so as to ensure that there is no material difference between carrying amount and fair value at the reporting date. And When you revalue, remember one thing, when you revalue one asset, you have to revalue all the assets belonging to that particular class. Revaluation is not done on only for one asset. Revaluation is done for the entire group of similar assets. So it's a group, the entire assets belonging to that particular class have to be revalued. Now, what I am going to do is I'm going to give you one shortcut table which will help you to keep in mind what happens in case of revaluation. Okay, so pay attention here. Let's start with a very interesting flow chart on uh, the treatment of revaluation in your financial statements. What is the topic? The topic is treatment of revaluation gain or loss. Treatment of revaluation gain or loss. As we write treatments one by one, I will also explain the logic behind each of these treatments. Okay, so don't worry about that. This is about treatment of revaluation gain or loss. So let's divide it into two categories, which are our two categories: first time revaluation and subsequent revaluation. Okay, so this is my first time revaluation. Now, if you want all of these charts, I request you to download my app, the link for which is given in the description. Download the app and all of these items are uploaded there for your reference. So, if the first time revaluation, okay, first time revaluation could be upward revaluation or it could be downward. First time revaluation is upward. What do you do? And first time revaluation is downward, then what do you do? If the first time revaluation is an upward revaluation, then the revaluation gain goes to reval surplus OCI. Revaluation gain goes to revaluation surplus OCI. OCI is other comprehensive income. If the first time revaluation is a downward revaluation, then the revaluation loss goes to profit and loss account. The first time gain is an unrealized gain. The first time or any upward revaluation is an unrealized gain. So if that gain occurs, what you have to do is you have to transfer the gain to revaluation surplus OCI. Now, one thing that needs to be kept in mind is that if the first time revaluation is a downward revaluation, then that particular loss goes to profit and loss account. See, the reasoning behind that is not something they will ask you in the exam, but you should know. The Again, we are following the prudence principle here to a certain extent. When I'm transferring a gain to revaluation surplus, it means the gain is unrealized. I don't want to be the one who is misleading my shareholders into believing that a gain has occurred. But if there is a downward revaluation, on most occasions, the downward revaluation is rarely reversed. If a downward revaluation happens, that means there has been a diminution in the value of the asset. And if there has been a diminution in the value of the asset, then that is usually of a slightly more permanent nature. Hence, it is routed through the profit and loss account, not through other comprehensive income. Now, let's see what happens in case of subsequent revaluation. First time is done. Now let's talk about subsequent. And there are a couple of alternative situations that can arise. There could be subsequent upward. Okay, subsequent upward. Subsequent revaluation is an upward revaluation. Then how do you deal with it? Upward means increase in the carrying amount of the revalued asset. If the subsequent revaluation is upward, ask yourself the question, was there a previous increase in the carrying amount of the revalued asset? Was there a previous increase in the carrying amount of the revalued asset? Let me frame this question in an easier way. So, subsequent revaluation upward was or was there a prior upward revaluation? Right now, we are talking about subsequent revaluation. The question is, was there a prior upward revaluation? If the answer to this is yes, then recognize the revaluation gain in OCI. If the answer to this is yes, then revaluation gain goes to revaluation surplus OCI. Okay. Revaluation gain goes to revaluation surplus OCI. Now, if the answer to this question is no, that means there was a prior charge, there was a prior downward revaluation. What do? You recognize the revaluation in gain in the P&L to the extent that it reverses the revaluation decrease of the same asset recognized in P&L. Remaining gain goes to OCI. For each of these, I'm going to show you small examples and calculations, so don't worry about it. Was there a prior upward revaluation? If the answer is no, then gain goes to P&L to the extent to which P&L was debited earlier for downward revaluation. Gain goes to P&L to the extent that it was debited earlier for downward revaluation, and gain over and above this, gain over and above this amount goes to revaluation surplus OCI. There will be examples and I will color code each example so that it does not become confusing for you. Now, this subsequent revaluation that we are talking about, what if this is downward? Okay. Oops. What if this is a downward revaluation? Subsequent revaluation upward. Now, subsequent revaluation downward. Was there a previous decrease in the... So what was the previous situation in case of this particular asset? Okay. Now, was there a prior upward? Here I am going to ask, was there a prior downward? Was there a prior downward revaluation? If the answer is yes, then the revaluation, the fall in fair value goes to P&L. Okay. Was there a prior downward? Yes. The revaluation loss goes to profit and loss account. And was there a prior downward? If the answer is no, or do you have any, was there a prior downward? The answer is no. Then recognize the revaluation loss in OCI to the extent that there is balance in the OCI, and then the remaining loss goes to P&L. Was there a prior downward revaluation? No. And then you ask, is there any existing revaluation surplus for this asset? If the answer to this question is yes, if the answer to this question is yes, then use balance in revaluation surplus to absorb the loss, and any loss in excess goes to P&L. Use the balance in revaluation surplus to absorb the loss, and any loss in excess goes to P&L. So this is the whole journey of your revaluation. So you had a subsequent, we saw what happens in case of the first time revaluation. Then let's see what happens in case of subsequent revaluation. In subsequent revaluation, you will have to see subsequent revaluation upward, subsequent revaluation downward. So this chart will form the basis for a lot of your questions. And if you go by this chart, I can assure you, you will never go wrong. Also, what we are going to do is, as I told you, we will be color coding everything so that it becomes easier for you to keep certain things in mind. So it's a big enough, it's a biggie, it's a big chart, but it is something, that you will find immensely helpful in your exam. As I told you, if you want this chart, unfortunately, I cannot upload it on YouTube. So I request you to send me to download my app, the link for which is given in the description box, and you can use that to download my app. All of this will be uploaded there. So this is about subsequent measurement. Okay, so now I'm going to label each of the circumstances as A, B, C, D, and then you're going to use it to understand A. Okay. So example A. Satyamed Limited purchases an asset for 50,000, which is revalued to 60,000 at the end of FI. This is first time upward. This is first time upward revaluation. What is the accounting entry? I'm not writing the accounting entry for purchase, which you know is non-current asset to cash. Here the entry will be by non-current asset account debit to revaluation surplus account. By non-current asset account debit to revaluation surplus account. Then example 2, first time revaluation is downward. What happens? This is situation B. The revaluation loss goes to P&L. This was example A. I'm going to make some small changes to this. This then becomes example B. Satyamed Limited purchased an asset which is revalued to 45,000 at the end of the year. This is first time downward. What is the accounting entry now? Downward revaluation is a loss. By profit and loss account debit to non-current asset account. By profit and loss account debit to non-current asset account, the value has reduced by 5,000. This is example B. Now, let's look at the next case now. Subsequent revaluation upward. Was there a prior upward revaluation? Yes. The revaluation gain goes to. Now, understand the situation here. First time revaluation has happened. Subsequent revaluation may the revaluation is upward, and you ask, was there a prior upward revaluation? If the answer is yes, this is if the answer is no. Was there a prior upward revaluation? Yes. So let's construct example C. So, example C. Satyamed Limited purchases an asset. First time revaluation is upward. Then 2 years later, it is revalued to 65,000. Subsequent revaluation is upward. Subsequent revaluation is upward. So again, you will have the same entry, non-current asset account debit to revaluation surplus 5,000. Non-current asset account debit to revaluation surplus 5,000. Now, after this subsequent revaluation upward, was there a prior upward revaluation? The answer is no. Gain goes to P&L to the extent to which P&L was debited earlier for downward revaluation. Gain over and above this amount goes to revaluation surplus OCI. Okay. Now I'm going to develop example B further. Okay, pay attention. So first time revaluation is downward. Then after 2 years, the asset was revalued at 54,000. Okay. Now, subsequent downward. Okay. First time downward, subsequent upward, down and then up. So, P&L has been debited by 5,000 for loss on account of revaluation. Now and right now, the revalued amount is 54,000. So that is a gain of 9,000. How 9,000? 54,000 minus 45,000, my current carrying amount. So to the extent that P&L has been debited earlier due to downward revaluation, we will credit P&L account, and any gain in excess of this 5,000 will get or will go to revaluation surplus. Okay, so what is the accounting entry here? 5,000 had been debited to P&L so far on account of revaluation. Now there is an upward revaluation. To that extent, you will credit P&L. So by non-current asset account debit, by non-current asset account debit 9,000 to profit and loss account. P&L account should be credited to the extent to which it was debited in the past. So 5,000, and balancing figure goes to revaluation surplus OCI. How much? 4,000. This is our example D. Please have a look at this one. This mirrors this situation. Subsequent revaluation upward. Was there a prior upward revaluation? No, which means the prior revaluation must have been a downward revaluation, which we have already discussed in example D. Now, let's talk about situation E. Revaluation loss goes to profit and loss account. Okay. What is the situation? Subsequent revaluation is a downward one. Was there a prior downward revaluation? The answer is yes. The revaluation loss goes to profit and loss account. Okay. The revaluation loss goes to profit and loss account. So let me make my case E. My case E is going to be an extension of my case B. Now observe this carefully. Example E, Satyamed Limited purchases an asset for 50,000, which is revalued to 45. First time downward, and after 2 years, it is revalued to 42,000. So what is this? Subsequent downward. By profit and loss account debit to non-current asset account. How much? 3,000. By profit and loss account debit to non-current asset account, 3,000. So from 50, it came to 45. From 45, it has come down to 42. This is example E, which we have seen in the chart. And now the last one. What is the last one? Subsequent revaluation is downward. Was there a prior downward revaluation? No. Check if there is any existing revaluation surplus for this asset. Use balance in revaluation surplus to absorb the loss, and any loss in excess goes to P&L. I'm calling this my case F. Okay, now let's start with this. I will modify my example A. I'll make it example F. Satyamed Limited purchases an asset for 50, which is revalued to 60 at the end of F5, first time upward. Subsequently, after 2 years, it was revalued at 47,000. Okay, so what is the downward revaluation? Downward revaluation is 60,000 minus 47,000 is 13,000. So downward revaluation of 13,000. We already have 10,000 in revaluation surplus OCI. Use the balance in this account to absorb the loss. Any loss in excess of this will go to P&L. What is the accounting entry? The accounting entry will now be by revaluation surplus account debit 10,000. You had a balance of 10,000 in this account, you utilized it fully. By profit and loss account 3,000 to non-current asset account 13,000. So there is a reduction in the value of non-current asset of 13,000. You already had a revaluation surplus to absorb the downward fall. You absorb that. Any loss in excess of that was transferred to your profit and loss account. So this, ladies and gentlemen, is how you handle a situation of revaluation. Treatment of revaluation, gain or loss. Just make sure that you go through this flow chart. And as I told you, please download the app so that you can get access to this and all the other free resources that will be shared from my end. Thank you so much.